Most entrepreneurs trust investment experts to guide them toward financial freedom. But what if that advice is quietly working against them? A lot of mainstream investing guidance is designed for people with stable salaries, predictable income, and zero business obligations. Entrepreneurs operate in a completely different reality, where cash flow changes, opportunities appear suddenly, and capital needs to stay flexible. Yet they're often told to lock money away long-term, follow rigid strategies, and ignore the needs of their own business. We'll break down why much of the expert investment advice doesn't actually fit entrepreneurs, and how that mismatch can hurt their wealth instead of growing it. Today we will talk about the investment experts are lying to entrepreneurs. So before we start, make sure to hit the like button and subscribe to my channel. 1. The one-size-fits-all investment myth. One of the biggest misconceptions spread by investment experts is that everyone should invest the same way. They often promote universal strategies that ignore individual financial realities. Entrepreneurs are frequently told to follow the same rules as salaried investors. However, business owners operate under completely different financial conditions. Their income is irregular, reinvestment-heavy, and risk-exposed. This makes traditional advice incomplete and sometimes misleading. Many experts oversimplify investing to create scalable content and programs. They ignore cash flow volatility and business reinvestment cycles. Entrepreneurs cannot always commit to fixed monthly investment plans. Business opportunities often require immediate capital allocation. 2. Just invest in index funds. Oversimplification. Many experts heavily promote index fund investing as the ultimate solution. While index funds are powerful, the advice is often oversimplified. Entrepreneurs are told to just invest and forget everything else. This ignores the need for liquidity in business operations. Capital is often required for expansion, hiring, or emergencies. Locking too much money into long-term investments can reduce flexibility. Experts rarely account for business cash flow demands. They assume stable income streams, which entrepreneurs do not have. This creates a mismatch between advice and reality. Index investing works best when income is predictable and stable. Entrepreneurs often face fluctuating earnings cycles. 3. Ignoring business reinvestment needs. Investment experts often fail to account for business reinvestment cycles. Entrepreneurs constantly face decisions about where to allocate capital. Reinvesting in the business can sometimes outperform external investments. However, experts rarely acknowledge this trade-off clearly. They promote external investing as always superior. In reality, timing and opportunity matter significantly. A growing business may require immediate capital injection. This can produce higher returns than passive market investing. Experts often treat all money as if it has the same priority. But entrepreneurs must balance growth and diversification simultaneously. Ignoring reinvestment needs can slow business expansion. 4. Risk misinterpretation problem. Investment experts often misunderstand how entrepreneurs perceive risk. They frame risk purely in terms of market volatility. However, entrepreneurs face operational, business, and liquidity risks. These risks are often more immediate and impactful than market swings. A failed business decision can be more damaging than stock fluctuations. Experts tend to underplay these realities. They assume investors can tolerate long-term market exposure easily. But entrepreneurs often need accessible cash at all times. Risk tolerance is not universal across financial profiles. What is safe for one group may be dangerous for another. Experts rarely adjust advice based on business exposure. 5. The liquidity blind spot. Liquidity is one of the most overlooked aspects in expert advice. Entrepreneurs need quick access to capital for opportunities. However, many investment strategies lock money for long periods. Experts often prioritize long-term returns over short-term flexibility. This works for salaried individuals, but not always for business owners. A sudden business opportunity may require immediate funding. Without liquidity, entrepreneurs may miss high-return opportunities. Investment experts rarely emphasize this trade-off clearly. They assume consistent income covers all needs. But business cycles are unpredictable and dynamic. Liquidity acts as financial oxygen for entrepreneurs. Without it, even profitable businesses can struggle. 6. The high returns illusion. Investment experts often highlight high average returns without explaining the full picture. They present historical performance as if it guarantees future outcomes. Entrepreneurs are told to expect consistent compounding if they simply invest correctly. However, real-world investing is rarely smooth or predictable. Markets go through cycles of growth, stagnation, and sharp decline. These fluctuations can significantly impact short-term financial stability. Experts often ignore the emotional and operational pressure this creates. Entrepreneurs may need to withdraw funds during downturns for business needs. This interrupts compounding and reduces long-term effectiveness. High return projections often assume uninterrupted investment horizons. That assumption rarely matches entrepreneurial reality. 7. The overconfidence in passive investing. Many experts promote the idea that passive investing removes all financial stress. They claim that once money is invested, it no longer requires attention. While passive investing reduces workload, it does not eliminate responsibility. Entrepreneurs still need to monitor markets and adjust allocations. Economic conditions can shift unexpectedly and impact portfolio value. Ignoring investments completely can lead to poor outcomes. Experts often simplify this process for marketing purposes. They emphasize ease while downplaying real-world complexity. Passive investing also assumes emotional discipline from investors. However, entrepreneurs face unpredictable income and expenses. This makes emotional consistency harder to maintain. 8. Misaligned time horizons. Investment experts often assume a long-term time horizon for all investors. They encourage holding assets for decades without interruption. However, entrepreneurs operate on shorter and more dynamic timelines. Business opportunities may require immediate capital reallocation. This creates conflict between investment strategy and business reality. Experts rarely adjust advice for these time-sensitive needs. They assume stability in income and financial commitments. But entrepreneurs deal with cycles of expansion and contraction. A rigid long-term strategy may limit short-term agility. Missing a business opportunity can cost more than investment gains. Time horizon mismatch creates strategic friction. 9. The hidden fee and structure problem. Investment experts often downplay the impact of fees and structures. They present returns without fully accounting for real-world deductions. Management fees, taxes, and platform costs reduce actual profits. These reductions may seem small, but compound over time. Entrepreneurs are especially sensitive to capital efficiency. Every percentage point matters when reinvesting in a business. Experts often simplify net returns to make strategies look more attractive. However, true returns are always lower than advertised figures. Complex financial products may also include hidden costs. These are not always clearly communicated upfront. 10. The reality experts rarely admit. The final truth is that most investment advice is designed for general audiences. It is not tailored specifically for entrepreneurs with complex financial lives. Experts simplify strategies to scale content and reach wider audiences. This often results in incomplete or generalized recommendations. Entrepreneurs need adaptive, flexible financial strategies instead. They must balance business reinvestment, liquidity, and long-term investing. No single system fits all financial situations. Real investing is not a fixed formula, but a dynamic process. Success depends on context, timing, and opportunity cost. Blindly following expert advice can lead to misallocation of capital. Entrepreneurs must critically evaluate every financial recommendation. If you like this video and would like to see more like it, please give it a thumbs up, leave a comment, and click the button to subscribe.